Hey, I'm Mason. You guys can call me May. And I'm a full-time day trader. And if I lost every single funded account that I had, lost all of my trading connections, and had to start all over again from the very beginning, this is exactly how I'd work my way back to 200K in trading profits. And when I say starting from zero, I mean $0 in trading profits. Obviously, prop firm evaluations cost money, so I'm not going to make it sound like you can literally begin without spending anything. But I would not start by buying 20 accounts, I would not start by risking everything on evaluations, and I definitely would not start by learning 5 different strategies at the same time. I'm going to go ahead and break down the entire process into 3 phases. Phase 0 is my background and what originally gave me the drive to become successful. Phase 1 is going from 0 to the first 10,000. Phase 2 is going from 10,000 to 50,000 while building a real portfolio of funded accounts. And Phase 3 is going from 50,000 to 200,000 by improving the model, diversifying, and protecting everything that I had already built. This is not supposed to be a video where I just flash payouts and tell you trading is easy. I want to explain the actual process, the strategy, the account scaling, the risk, the mistakes, and how I would approach everything knowing what I know now. So let's go ahead and get started with phase 0. Before I talk about prop firms and trading strategies, I want to explain where my mindset came from. Now, I come from a Ukrainian family. My family moved to the United States because they wanted to create a better life and give us kids opportunities that they might not have had themselves. Because of that, success has always been extremely important to me. I have always felt like I need to make something out of the opportunities I was given. Not because anyone forced me to become a trader, but because I knew I wanted freedom, independence, and the ability to create something for myself. Now, that's why I wrote success was never optional. It does not mean I believed I was guaranteed to succeed. It means that I was always going to keep searching until I found something that I could become great at. And I did not start with any type of professional trading background. Nobody in my family was a trader. I didn't learn anything in college from trading. I did not have a mentor walking me through prop firms, risk management, order flow, or how the market actually moves. I had to learn through trial and error. I watched different traders. I learned different concepts. I changed strategies. I failed accounts. I had good periods where I thought I finally figured everything out. And then I had bad periods where I questioned everything that I was doing. And that is one of the first lessons I would carry with me if I had to begin again. You do not need to learn every single concept on the internet. You need to develop one clear way of viewing the market and understand it deeply enough that you can repeat it. Now, this is just an example of how I started. I was just trying to understand everything. There was different levels, tools. I had 5 different stop losses and take profits. I was just entering just to enter here. Over time, I began simplifying everything and developing my own understanding of the market, and that process eventually became the May inverse model. Now, my background is what really gave me the drive, but the drive itself was not enough. Trading required a real process, and that brings us into phase 1. Now, phase 1 in general is just going from $0 in trading profits to the first 10,000. And if I had to do this again, my objective would not be making 200K. It would not even be making 10K. My first objective would be proving that I could actually get paid one time, because there is a massive difference between making money temporarily inside an evaluation and actually developing a process that can survive long enough to produce a payout. Most importantly, stop switching strategies. A lot of traders learn one concept, take 3 losing trades with it, and immediately decide that that concept does not work. They move to another strategy, then a different indicator, or even a different mentor, and every time they switch, they restart the learning process from the beginning. I would choose one model and commit to collecting enough data to understand whether I actually had an edge. For me, that model would have been my May inverse model that I had created all by myself. It is not just one entry pattern. It is a framework for putting several pieces of information together. I want to understand the higher time frame draw on liquidity. I want to know where price is trying to deliver, and etc. And most importantly, the goal is to stop taking trades because the chart simply looks bullish or bearish. I want a reason for the entry, a reason for the stop, and a reason for the target. Now, once you've built that one repeatable trading model, you're going to go ahead and aim for passing that first evaluation. Now, once I had that model to understand, I would purchase one evaluation, not 20, not every account type that was released. The whole entire goal is to be able to prove that I could pass an evaluation without relying on one random oversized trade. And I would define the risk before I ever started. How much am I willing to lose on the evaluation? How many attempts am I willing to purchase? What setup am I allowed to take? When do I stop trading for the day? And those decisions should be made before emotions are ever involved. Now, for me, this is where everything began to really feel real. Getting that first ever funded account was a great accomplishment, but the funded account itself was not the final goal. The goal is to receive an actual payout. A funded certificate does not mean much if you immediately lose the account before ever withdrawing any money. So once I became funded, I would reduce the urgency, I would focus on building enough of a cushion to protect the account and then work towards that first payout. Now, as you guys can see, this is my first ever payout right here. This payout was on November 21st, 2025, and it was only $400. Your first payout does not need to be $10,000. It does not need to impress anyone. The first payout is proof that you are actually able to follow a process long enough to turn trading performance into real money. That is the first major milestone. Now, what we need to aim for after getting our first payout, you do not go and blow it all on some stupid things to buy. Almost all of this $400 payout amount got reinvested back into additional evaluations, which ended up creating the first scaling cycle. I build my model, I pass the evaluation. After passing the evaluation, I gotta protect the funded account. Then you receive your payout, and then you reinvest almost all of your payout into more accounts. Then you just continue repeating that same process across more and more accounts. Now, before trying to use 5 different firms, I would begin by maximizing my allocation with one reliable firm. That keeps the rules simple. You are not trying to remember 5 different payout policies, drawdown types, consistency rules, and trading platforms while you are still learning to become consistent. You prove that the process works with one firm, you learn how that firm operates, and then you repeat the model across the available allocation. Now, you never want to scale a strategy that has not proven it can get you paid, because you copy a bad process across more accounts, you are not fixing the process, you are only multiplying the damage. That first $10,000 is about building the edge and proving that the edge can produce real payouts. Once that has been proven, we move now into phase 2. Now, phase 2 is where trading really starts turning into an actual account portfolio. At this point, the goal is to begin scaling towards 10 to 20 funded accounts, but you cannot manage 20 accounts with the same mindset you used when you only had one. This phase is just primarily about risk. The first thing I would do is separate evaluation risk from funded risk. An evaluation and a funded account serve 2 completely different purposes. The purpose of an evaluation is to reach the profit target and earn access to that funded account. But then the purpose of that funded account is to survive, become payout eligible, and withdraw real money. So I would not necessarily manage them exactly the same. Now, on evaluations, I would use calculated aggression, and I want to be careful with that wording. Calculated aggression does not mean blindly gambling the evaluation. It means deciding beforehand that I'm willing to use more risk on an evaluation than I would use on an account that is already funded. Now, I would define a max loss, our max weekly loss, and how much we want to copy trade. I would aim to pass efficiently rather than paying recurring fees for months while being scared to take a valid trade. But once the predetermined risk is reached, I stop. I do not revenge trade. I do not immediately buy 5 more evaluations because I am angry. I do not increase my size just because I'm trying to make my money back. The aggression still needs to be 100% controlled. Now, once the account is funded, the priority changes completely. Now I'm protecting something that can produce real payouts. For me, 6 to 8 micros should be used on every single trade. The stop distance matters, the setup quality matters. 6 micros with a small stop is completely different from 6 micros with a huge stop. So I'm always thinking in terms of the total dollar amount at risk, not only the number of contracts. But that 6 to 8 micro area allowed me to make the trade meaningful without feeling like one loss was going to destroy the account. I also would limit the number of trades. 1 to 2 high quality trades is more than enough. The more funded accounts you have, the less you need to force the market to give you something every single day. Now, if we come over here, This trade is a perfect example of why setup quality matters more than simply trading more often. This was my biggest trade ever. It was taken across 27 of my funded accounts, but I did not take it across 27 accounts just because I wanted to gamble. I took it because everything I wanted to see was aligned. We had a 4-hour gap delivery up here that gave me the higher time frame context for where price was trading from and where it could potentially deliver next. We also had our session liquidity being swept above the high instead of simply continuing higher, and after that sweep, we also had an SMT divergence with ES. That showed me that the market was not only confirming each other at the highs and gave me another reason to look for the reversal. Then we also had that 5-minute inversion right here that gave me the actual entry framework. Then below us we had our clear targets at sell side liquidity. That is extremely important. I was not entering short and hoping price would fall. I knew where the liquidity was resting and where I expected price to deliver. And because it was copied across 27 accounts, the result became my biggest trade ever. But the lesson is not that everybody should immediately copy one trade across 27 accounts. The lesson is that your portfolio exposure becomes extremely serious when one setup is multiplied across that many accounts. Now, if we come over here, let's use this example on the board. If I'm risking $200 on one account and that trade is copied across 10 accounts, I'm not really only risking $200. My portfolio exposure is $2,000. And if I copy that trade across 20 accounts, that exposure becomes $4,000. So at this level, I need to manage my drawdown across the entire portfolio and not pretend that every account exists in isolation. Like we said before, we're establishing our max loss, our max weekly loss, and after reaching a certain level of drawdown, I would automatically reduce my size because the biggest danger is not one account failing. The biggest danger is allowing one emotional decision to damage every single account at the same entire time. Now, once those accounts continue producing those payouts, I continue with the withdrawal and reinvestment cycle. You withdraw your payouts, you keep a little percentage of it to yourself, and you reinvest the other percent into new evaluations or replace any accounts that have been lost. Then just continue building towards that desired allocation. This is exactly how I would work towards a 10 to 20 account portfolio, but I would not judge the process based on whether every individual payout was massive. Now, if we come over here, this calendar is important because it shows something that gets ignored on social media. Not every profitable day needs to be some massive winning day. You can clearly tell May 2026, a lot of days on this calendar are much smaller wins, and that is completely fine. Some days may be a few hundred of dollars, some days may be larger, and some days I literally don't even trade at all. What matters is where the process remains consistent over time. A small green day followed by another controlled green day is more valuable than one huge win followed by several emotional losses. The size of one trade does not determine whether you are a good trader. The ability to repeatedly protect capital and take high quality setups is what matters. Now, multiple accounts do not mean separate different trades. They create one larger portfolio position. Phase 2 is about scaling the edge without allowing the increased account to destroy your discipline. Once I had built that portfolio and reached roughly 50,000 in profits, I would move into phase 3. Now, phase 3 is where I would begin improving the edge while also protecting everything that I had already built. And this is where I begin creating a new and improved model. I did not completely abandon the original strategy. I took the foundation that was already working and began integrating way more information into it. The original model gave me the price action framework, but I still wanted a lot more clarity in what's going on in the markets. So I started integrating bookmap, order flow, and options flow like GEX and gamma levels. I would also begin to diversify across multiple reputable prop firms. In the earlier stages, it makes sense to keep everything simple and focus on just one firm, but when a meaningful amount of income depends on multiple prop firms, relying entirely on one company creates unnecessary risk. A firm can end up changing rules, it can change payout requirements, it can reduce your allocation, or it can simply stop being a company you are comfortable keeping all of your accounts with. So I would spread the account portfolio across different firms, especially once you max out with 5 accounts, which ends up being max allocation on most prop firms. But you have to make sure that you're keeping this very clear. You only diversify the firms, you do not diversify your strategy. I would keep the same core edge and spread the operational risk just across different accounts. Now you need to make sure you're tracking every single account and rule. When you manage accounts across multiple firms, organization becomes extremely important. Every firm can have different rules, different drawdowns, different payout dates, different consistency requirements, different account limits. So I would keep an account tracker that shows you the current balance of all of your accounts, the available drawdown, whether the account is payout eligible, the next withdrawal date, the firm's rules, and the total risk currently being taken across the portfolio. At this point, trading literally has to be treated like it's a business. Now, maintaining your cash reserves outside of prop firms. I would also stop reinvesting every single dollar. In phase 1 and early phase 2, reinvesting is exactly what helps build allocation, but at some point, constantly putting all profits back into prop firms becomes unnecessary. I would begin maintaining real cash reserves outside of the firms. That way, if accounts are lost or a firm has an issue, I still have capital that I completely control. I would withdraw regularly, I would separate taxes, I would maintain operating capital for evaluations and software, and I would gradually move profits into my live trading account and longer term investments. The point is to turn prop firm payouts into real personal capital. Now, most importantly is to protect the downside above everything. At this stage, protecting the downside becomes more important than maximizing every possible winning day. One bad trade should not destroy your portfolio. One bad day should not destroy the portfolio. And even one bad week should not take away months of progress. That means reducing size whenever you're in drawdown. It means stopping when the portfolio level loss limit is reached. It means not increasing risk because you are trying to recover quickly. And it means accepting that survival is more important than the speed. Now, if we do a little recap, phase 1 is all about finding the edge. Phase 2 is about scaling that edge. And most importantly, phase 3 is about protecting that machine that the edge is created on. Now, also in phase 3 was where I decided to start taking things into my own hands. I started creating indicators, my May inverse indicator that marks out all my liquidities, my fair value gaps, and even projects a setup onto my chart for me. Same with my Gex and Gamma indicator that is marking out every single level for me. Phase 3 is just really all about treating this like a business. This is where you are really going to skyrocket past your original goals, just as long as you continue protecting everything that you started to build. Now, before I close this video, I want to show some proof behind of what I am explaining. I do not want this roadmap to sound like a theory that I created it without actually trading it. This is just some of the payouts that I received in February and March on Tradeify, and I'm not showing this because every payout was perfect or because I believe a payout screenshot automatically makes someone a great trader. I'm showing them because the model and the process have produced real results. And each payout represents more than one winning trade. It represents passing the valuation, keeping the funded account live, reaching the payout requirements, and actually withdrawing the money. That is the full process. Now, if we go over here to this calendar, this is my live account calendar from June inside of TradeZella. This is important because there is a different psychological feeling when you are trading your own live capital. With a prop firm, you paid an evaluation fee and are trading within the firm's rules. With a live account, every single gain, every single loss directly affects money that belongs to you. So this helped me prove that the process was not only something I could apply to evaluations or funded accounts, but I can also take the same model and use it while trading my personal capital. And again, the goal was not to make every single day massive. The goal was just to remain controlled. Take the setup that matched the model and build the consistency throughout the month. Here's just another example of some trades that I've taken. This trade was just a very good example of how the Gex and Gamma indicator became part of the updated model. We had a very important Gamma level marked out here, and price traded into that area and gave me the confirmation I was looking for. Instead of randomly trying to call the top, I had a meaningful level that lined up with the rest of my analysis. The reaction allowed me to get a very clean top tick entry, and the Gamma level gave me the location then the price action gave me the execution, and this is how I was using my gamma and gex indicator. Now in this trade is another example of how all the pieces began working together. First, the heat map showed orders being filled up here. That gave the order flow confirmations that something meaningful was about to happen at that level. We also had a 1 hour gap that we just disrespected and were bouncing off of, and that led directly into a 3-minute gap that we ended up inversing. And below, I also had the 930 Judas swing as my target. So once again, I was not entering without a plan. The 1 hour gap gave me the context, the heat map and filled orders gave me the order flow information, and the 3-minute inversion gave me the entry. Price delivered into my target, and I was able to take full profit there. This is what the updated May inverse model looks like to me now, as I'm combining price action, order flow, options levels, and clear liquidity targets instead of relying on one isolated signal. Now, let's get into what you guys should do. First, identify what phase you are currently in. Do not compare yourself to somebody managing 20 accounts when you have not yet developed one repeatable setup. Your current phase determines what your actual priority should be. Second is to stop trying to skip phases. You do not need 20 evaluations when you have not proven that you can manage one funded account. You do not need 5 prop firm accounts when you have not even received your first payout, and you do not need a complicated portfolio tracker when you are still switching strategies every single week. Complete the phase you are currently in, then you continue moving forward into phase 3. Choose one setup and study it deeply. Understand the conditions that make it valid and understand what invalidates it, and also understand the best market environment for it. Now just get one legitimate payout. Your first major objective should be receiving one real payout, not posting an evaluation profit screenshot and not showing an unrealized balance, just a real payout. That proves that you can complete the entire process. But one payout is proof of possibility, and multiple payouts begins proving repeatability. So after that first payout, do not immediately assume you have mastered your trading. Continue collecting data and proving that the process can work across different days and different market conditions. Now you want to reinvest strategically. Use a portion of the payouts to grow, but do not blindly recycle every single dollar into new evaluations. Keep some of your money, reserve some of it, reinvest a calculated amount, and scaling should improve the business, not create more financial pressure. Now, once you begin copying trades across multiple accounts, calculate the total dollar risk and never hide behind the fact that the risk looks small on one individual account. What matters is the total loss if every copied account loses at the same time. You also want to protect your funded accounts. The goal of a funded account is to produce payouts. Do not manage it like an evaluation. Reduce the urgency, control the size, and prioritize survival. Now diversify only after consistency. Do not complicate the process too early. First, master one firm and one model. Then diversify once you have a reason to protect yourself against company and operational risk. Now last but not least, eventually the money will come, the money will go. But most importantly, your money needs to leave the prop firms. Build real reserves, build a live account, invest in crypto, invest in anything, pay yourself, handle your taxes, and move some of the profits into assets that you can completely control. Now, do not scale confusion, you want to scale proof. That is the entire message of this roadmap. First, prove that you can get paid, then prove that you can repeat it, and after that, scale and protect the process. Now, I hope most of this made sense to you guys, but now I've worked with traders at all of these stages. So if you are interested in learning from me, there is a link in the description to apply for my program. It is probably going to close within the next month or so, but I'm not sure. But that is just exactly how I would turn $0 into $200K if I had to start from the beginning all over again.